In a move that's been anticipated for months, the Federal Reserve recently reduced its benchmark interest rate by 0.25 percentage point, lowering it to a target range of 4.50%–4.75%. This November decision marks the Fed's second consecutive rate cut, as it seeks to recalibrate its monetary policy amid economic challenges and a complex political landscape. Federal Reserve Chair Jerome Powell emphasized the need for a balanced approach, noting that supporting employment is now as critical as managing inflation. With inflation having shown signs of cooling but still above target, the Fed's decision reflects a more cautious pace, responding to shifting economic signals. This adjustment follows September's larger half-point rate cut, with officials now opting for a more gradual approach. The Fed's recent rate cuts have significant implications for consumers, as the benchmark rate often impacts costs for mortgages, car loans, and credit cards. While the Fed aims to ease borrowing costs, this effort faces some challenges. Despite the Fed's lowering rates, the broader market has pushed Treasury yields upward, reflecting investor concerns over potential inflationary pressures from newly elected President Donald Trump's policies. This means that while the Fed rate is dropping, other rates like mortgage and long-term loan rates may remain elevated or even rise due to market forces. With stocks responding positively to the Fed's announcement, indices such as the Nasdaq and S&P 500 reached record highs shortly after the decision. Meanwhile, Treasury yields, which had climbed previously, declined, showing investors mixed sentiments about the Fed's approach and the broader economic forecast. Jerome Powell described this policy shift as a recalibration to bring inflation closer to the Fed's 2% target, while supporting job growth. The Fed's statement noted some softening in labor market conditions, as recent payroll data indicated slower employment growth, partly due to recent labor strikes and adverse weather. Yet, overall economic growth remains solid, with third-quarter GDP growth at 2.8%. The Fed's approach appears to reflect confidence in the economy's resilience, even as it monitors potential inflationary impacts of future fiscal policies. Looking forward, investors are divided on the Fed's next steps. Many expect another rate cut in December, with the possibility of a pause in January to assess policy effects. This cautious path acknowledges potential market and policy shifts, especially given concerns about inflationary pressures from Trump's proposed tariffs and immigration policies, which could lead to higher prices on imported goods and potentially impact the job market. For now, Powell reassures that political changes will not influence the Fed's immediate monetary policy actions. But with Trump's history of advocating for lower rates during his first term, some analysts foresee potential pressure on the Fed's independence. Powell emphasized that the Fed's mission remains focused on economic stability, not political agendas, even as the economic environment continues to evolve. In summary, the Fed's recent decision represents a careful balance. It supports employment, while continuing to monitor inflation. This recalibration suggests a flexible approach, as the Fed navigates the complex landscape of economic signals and evolving fiscal policies. Whether this will lead to further cuts, or a shift in strategy remains uncertain, but the Fed's cautious steps indicate its commitment to fostering a stable economic environment in the face of multiple, and sometimes conflicting, economic pressures. Stay subscribed for more videos.